Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Enbridge's stock so we can determine if it's a buy or a sell. Enbridge owns, transports, and stores crude oil, natural gas, and renewable energy. To put it simply, it makes money by storing and moving energy through its pipeline to various customers in the US and Canada. The company is headquartered in Calgary, Alberta, Canada, and was founded in 1949. The ticker trades on the TSX, New York Stock Exchange, Deutsche Börse, and London Stock Exchange. Let's get started with the model. This is a large cap company, 108 billion market cap. They're trading at $53 a share, and they have 2 billion shares outstanding. We'll look at the ticker that trades on the TSX. So all the numbers in this video are in Canadian dollars. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have positive free cash flow each year. It was really high in 2022 at 6.4 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was highest in 2021 at 6.3 billion. It did come down a lot to 2.9 billion in 2022. They probably passed through lots of impairments. That's where their net income is low and their free cash flow is high. Revenue is the sales for the company, and that peaks in 2022 at 53 billion Canadian dollars. Let's look at their capital structure. 60 billion of equity, 81 billion of debt. They're 43% equity, 57% debt. Their net debt is also 80 billion. They don't have much cash on their balance sheet. I gave them the lowest whack on Finbox, 12.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 91 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $76 billion. We divide that by 2 billion shares. And we get a calculated stock price of $37. They're trading at $53, so they're trading at a 43% premium. It's a sell according to the model. Simply Wall Street also thinks they're overvalued. Their valuation is $47. 6 analysts priced this stock, and the average price target is 46, the low is 39, and the high is 55. This is where the stock has been trading the last 5 years. It got real low at the end of 2020. Oil prices must have crashed at this time. When oil prices increase as they did in 2021, so does their stock price as well as their profits. So the stock got close to $60 at the beginning of 2022. It did fall to below 50 a few months ago, but it has come back up to over 50. They raise their dividend each year. It was 67 cents in 2018, up to 89 cents currently. They pay a high yield of 6.7%, but it doesn't look like they can afford that. It's 113% of their free cash flow. So they either need to cut their dividend or generate more free cash flow. To summarize, I have them trading at a 43% premium. They do pay a nice dividend, and I rank their free cash flow as 8 out of 10, their revenue 8 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Thanks for watching.